projects you want to fund. So I'm joined today by 2 bankers and 1 developer. We hope to have a discussion free-flowing, I hope. We'll see, and we'll take some questions towards the end. I'm joined by, starting on my immediate left, Oliver Ebner. Oliver is an executive director with National Bank of Abu Dhabi, based in Abu Dhabi, and looks after their project and specialized finance area. He's a generalist in project finance, but being a generalist in project finance in this part of the world, you're going to come across hotels. There's some various hotels transactions. Then I have Zain Qureshi from Mashreq, again, corporate banker, heads up the real estate and real estate advisory and finance team within Mashreq, based here in Dubai. Again, a generalist, but plenty of hospitality and leisure transactions under his belt. And also worked with most of the big real estate players in the region. And then finally, I've got Kabir Mulchandani, who is the Group Chief Executive of SKAI, which is one of the fastest growing developers in the region, very successful over the last few years. And within their portfolio have a couple of hotels, being the Viceroy hotels in Dubai, one on the Palm, one in JVC. So that's our team. As I say, we'll take questions at the end. I wanted to start with liquidity in the markets, in the debt markets in particular. We've seen lots of stories and mega trends happening around the world, and nobody will be oblivious to them, which suggest that liquidity is going to tighten over the next few years. The 4 mega trends that we see happening at the moment, one of them is obvious to everybody in this room, which is that governments have become net borrowers rather than net lenders to the system at the moment. That creates a drain on liquidity. But there are some other and equally pressing mega trends happening in the market, I think, as well at the moment, and they are the project financing demands of this part of the world for its massive petrochemicals, massive infrastructure, and events financings that are coming up, things like Expo, things like the World Cup, etc. But not just in this country, but across the region. There are something like 44 mega projects and 250 big projects, and by big we're talking about above $1 billion. So the demand that's going to come to the market in the next few years is colossal. And hopefully that will drive the diversification of the economy over time. So that's the second big trend. The third big trend is that quantitative easing in the US has come to an end. Interest rates are gradually rising, and things are beginning to suggest that the dollars are going to be sucked home, and that there's a general increase in cost of funds, etc. And then the last trend is regulation, where capital requirements are increasing. Basel III is being introduced, and the central banks over the cycle are becoming tighter. So we see lots of suggestions that winter is coming, but I'd like to explore with the bankers to start with whether that's really a true reflection of what's happening on the ground. Can I start with you, Oliver?
Sure.
What are your views on that one?
Yeah, interesting topic you're starting with. Let me make some few comments and bring some clarity on some of these issues. Yes, it's true. There were deposits being withdrawn from the bank's balance sheets that has put pressure on liquidity. The loan-to-value ratios went up, and then banks needed to go out and repair that. Various measures have been taken. I actually have to give good credit to our treasury guys. They did a good job and raised deposits from institutional investors worldwide and increased the deposit ratio again to a level that it's workable. Yeah, it's decent. Mm-hmm. Other banks have their toolbox, what they're doing. Again, deposits, maybe increase a bit of margin to attract deposits, issue loan amounts. So the the sentiment that you sometimes maybe hear on the market, I think it's a bit too negative from what we actually see in the bank's balance sheet and also the willingness on the lending side. So deposit bases are on the increase, but also it means bringing in new deposits and issuing new loans comes at a different price point. So the funding cost on the bank side ticks up, and that then is being translated into an uptick in margin on the lending side. Yeah. No, and all these things have started off with basically withdrawals of dollars. So dollar pricing also among the banks when they issue loans is on the rise, steeper than on the dirham side. Now, one other observation, Q1 lending volume this year was higher than last year. Let's take a moment to settle that. Higher than last year. You have all that market perception, still volumes are higher. There are a few elements of maybe of distortion. Some mega issues were there in the market. Saudi had a $10 billion issue, Qatar 5, UAE, there was some corporate debt in the issue of $3 billion on 2 transactions. Oman had one of their projects in the $3 billion range. All of that was dollar denominated, and you're wondering maybe, well, all that lending capacity being taken out of the bank system, what impact does it have? But let's have a closer look who provided the funding for these large issues. It was done from international banks, from their dollar loan book. Next to no local bank came into these transactions. So these issues were priced for the international markets who have less of the local issues that the banks are dealing with here in the regional markets. So it means the funding base in dirhams, or let's speak regionally, in their local currency, is broadly speaking, is workable. It's doable. We can still see banks being positive on business, have risk appetite. They still have budgets to achieve. We see it on a day-to-day basis when we talk business that we are competing and or working together. Yeah. So dirham liquidity is there. I also saw on one project in Kuwait where the local banks managed to get a tranche out of a bigger project to be denominated in local currency. So because there is liquidity there in local currency and banks are looking to employ that. Yes, still local currency margin are on the uptick, but in a workable dimension, I would call it.
Okay. And is it patchy across banks, or are banks uniformly liquid?
No, I think dirham liquidity is
good across the board.
Is okay.
Okay, good. Zain, do you have thoughts on?
I completely agree with Oliver's statement there. Liquidity is better, but the environment is tight. There is a lot of demand for growth in the region, infrastructure, different assets, and what it comes down to is the ability for a sponsor to go ahead and fulfill this project through different liquidity sources. So you've got the banks on one side, but that's one pocket. There are a lot of other pockets that can come together to form something which is a successful project itself. On the hotel side, it has been fairly limited. Residential, retail, commercial has been a higher level of retail involvement. But I think hotels are becoming more and more innovative. They are looking at going ahead and pre-selling some of their assets in order to shore up liquidity for the project, for the construction, and for it to be a success.
Okay, good. And do the banks come and knock on the door as frequently as they used to?
Well, so long as you're building on time and on budget, they're always there.
Yeah. Okay.
No, but I think that's the key point. Fortunately, both our projects are on time and on budget, and we have had tremendous support from the banks. And everything that you read in the newspapers, yes, banks are there every day saying, don't repay us early. Find a way to continue the facility. So I think it's about the quality of the project. Yeah. I don't see a shortage of liquidity personally. I don't think there is that shortage, but banks have definitely become more careful. They are putting in a lot more stringent CPs, post-transaction covenants in terms of making sure budgets are met, project monitors are appointed. So for example, our banks have somebody representing them on all our sites daily, making sure on a day-to-day basis where is progress, certifying every single payment. Now, honestly, I think that's a good thing. It keeps us, on a tight leash, which is good, brings some discipline into us as developers, and we are accountable on a daily basis as to what we're doing. So is the money there? Yes, the money is there. What is it there for? It's there for what should be built and what's good to be built, which is the way we will start going away from glamorous projects that should not be built into commercially viable projects that should be built.
Yeah. And in terms of financing those projects, your projects have been quite interestingly, innovatively financed using some of the tools that have been used elsewhere. Do you think the markets are shifting in that general direction that traditional bank debt and equity financing is going to?
It has to, because banks can't keep taking up all the slack for what has to be built. First, sponsors have to come in with equity, or come in with, what we did was we sold our hotel rooms, we sold our residences. Now, and that brought our equity levels, to about 70%, over 70% now. So when you go to a bank and say we need 30%, which is, 2 years funding for a 4-year project, they have a much higher appetite and they're much more comfortable. And they've already seen enough progress on the project. You're not going to them with a piece of paper and something in the ground. They've seen the drawings get approved, they've seen construction start, they've seen some of the risk being taken off the table. And this is the time at which sponsors should start approaching banks for financing.
But, sorry, were these sales executed prior to construction completed, or was it after?
Yeah,
it was.
So
they were also taking
the sales were
construction
construction started in. We'll take the Viceroy on the Palm. Construction started in May of 2013, and sales were executed around the same time. And we got our first tranche of financing in 2014.
Fantastic.
So looking forward a little way, what we hear is that there are some mega projects coming down the pipe at us, things like Expo, etc., other major developments. Are banks encouraged to reserve some of that liquidity for these projects, or do you see it tightening over the next 2 to 3 years as these projects come to fruition, as it were? Do you think do we have a window of opportunity now at which things should happen?
Different things, first of all. Some of these projects are done on EPC basis. They're not so much done on absorbing direct lending capacity for the banks. So part of these projects are government funded in line with progress completion. Yes, obviously then are associated projects, and then they do need capacity, and yes, the banks will be approached and partly are being approached to work on that. But it's also a staged process. We're talking about a number of years over which these developments will happen. So it's not all the capex coming in the first year. So it's a normal development in that respect.
But do you see liquidity tightening from where we are today over the next 2 to 3 years or not?
Again, that's a bit of an issue where the dollar price goes and how much development is required locally here. What I do see, so nobody really has the answer to that. But there's a perception in the market. And clients are already acting upon that perception.
That's what we see as well.
So, for example, we see a couple of clients coming to us asking for extension of loans which would mature later this year, next year, maybe even year after, and say, yeah, let's just sit together and talk about longer tenor and just lock in longer term financing.
Deal with it now whilst the conditions are still favourable, as it were, in case things get tight.
Yeah, nobody has the crystal ball.
No, absolutely.
But just some clients take sort of early steps.
Yeah. Okay, we've talked also about the fact that there was a bit of a battle for deposits going on, but that's stabilised by the sound of it. The banks have managed to, as it were, remedy their balance sheet so they can stay as active as they want. What's that going to do to pricing over the next 2 years or so? Pricing firming like everybody believes it's going to, or?
I would expect a pricing to go up actually further. Yeah, that's the general sentiment, and I would sign up to that. I do see it in the market. 25, 30, 40 basis points uptick. But also let's go back a bit. Pricing had come down over the last years. So we started off from a higher base. It came down. It now is coming up a bit.
Yeah. So do you think we've gone from, as it were, a glut of liquidity to normal liquidity in the market rather than shortage, if you see what I mean? So
I think there are uncertain times, and whenever you have uncertain times, you have liquidity issues. You have pricing issues, but I think the key element that you have in this region is not the liquidity, it's the ability to provide funding for the number of projects which are coming up. Now we are looking at 2020. We are looking at a fairly significant capital intensive period.
yeah.
Banks are under pressure to go ahead and support a lot of these projects. Obviously, the viability of these projects is extremely important, and the viability is becoming more and more sensitive. Like Kabir was mentioning, that banks are sending out their engineers to look at these projects on a daily basis, and the rationale for that is we are worried about the viability. We are worried about the payback time, the period, whether these projects make sense from the economic point of view. You will have a significant number of rooms coming on stream by 2020. Is that sustainable going forward? Is that something which Dubai is geared up for? And those are the questions we need to ask as an institution.
Yeah. Do you see we talked a bit about pricing, but in terms of the sort of debt to equity levels that banks are willing to take on and the conservatism in the deals,
Yes.
do you see the dial moving on that more substantially than on pricing?
Yes, I see far more conservative covenants come into play. I think Oliver had mentioned that earlier. Loan to values, debt service coverage ratios expected once the project is completed, taking on construction risk or utilizing existing assets that the sponsor may have to provide or monetize those assets, provide him liquidity. So it's a combination of a few things. In addition to that, you are looking at a landscape where asset values could erode very easily and significantly if not addressed, owing to which loan to values and debt to equity ratios are being monitored closely.
And I guess that
just one word coming up to that point. What I see in the market, yes, I can subscribe to that, Zain. But I think sort of from the quality sponsors and their development, I don't see much change in business approach. It's similar levels of LTV that I would see a year before or 2 years ago. Where I see more pushback from banks are on the racy projects, the marginal projects.
I completely agree with you. So you've got a quality of sponsors, sorry to interrupt you there, who are extremely strong track record, ownership, have the ability to go ahead and complete projects from other sources too, and that's where the loan to values, the debt to equities would not change. Where the slightly racier projects or smaller sponsors, that's where it becomes far more conservative.
And I guess that's where the dial starts to really move, is when it shifts the project economics for different debt levels.
To talk about financing costs. I mean, if you look back at the last 20 years, we are still in the era of cheapest money ever. And what's 25 points? I mean, I know this means a lot to you guys, but if we look at financing costs, our total financing costs are about 4% of revenue. And if it increased by 25 points, that would increase to 4.07% of revenue. So really, is 25 points going to make a difference or make a decision where we're going to do a project or not going to do a project? No. And I don't think I mean, if it is going to make a difference, especially in development, if 25 basis points on your financing cost makes a difference, do not start it anyway. Absolutely not. So if money becomes slightly more expensive, I mean, you take the most conservative view and say, okay, we're going to increase another 1% in the next 1 year. I don't see that happening. I think there might even be a cut, but then, that's my view. But let's say it increases 100 points in the next 1 year. It still doesn't make things unviable. If you have a commercially sound project, that's not going to matter. If you don't, it's not right now, and it won't be right after it increases 100 points.
Completely agree with you.
To summarize, we've just been given the 5-minute warning, guys, so we need to take a couple of questions from the floor. But to summarize, it sounds like it's going to be a more disciplined market, but still very much one where well-structured transactions can flourish. Can we open any questions from the floor before we wrap?
There's a couple there.
Somebody over there.
So, over there.
Hello, my name is Yasser Bukhamsin from Saudi Aramco Pension Fund. I want to thank you for your feedback, and my question are to the bankers. Just from your institution perspective, what's the appetite for cross-border funding, particularly to Saudi Arabia? We have seen over the past week the commotion and the new excitement about the new vision, but then coupled with that is the legacy in 2013, 2014, where the family saga of the two rival groups that has dented the reputation a little bit of corporate lending in Saudi. So if you could just touch on that. And second is, I'm not really familiar with how the funding structures and scheme for project finance in the UAE is, but if you, just with my limited experience in the Saudi market, for example, for project development, the bankers are very hesitant to accommodate bullet payments or balloon payments, always amortization, very stringent requirements. So how does that compare with the UAE? And probably Mr. Kabir also could comment on that, how accommodative the banks are. Thank you.
Can I take question 2 first? I think it's, when you're talking about providing debt and getting repaid on a bullet payment, it's got to play with the nature of the asset. If the sponsor is telling me I'm going to go ahead and hold this asset I'm going to construct it, hold it for a period of time and sell it, a bullet payment makes sense. If he's going to hold it for a period of time, he's going to hold it for 10, 12, 15 years, which is far longer than a normal amortization. I would want to be part of that particular journey. So if he's getting a certain return on that particular asset, I would like to get repaid to a certain amount during that life. That doesn't mean I can take a balloon, which is maybe slightly higher proportion than I should be taking. That's fine. That could be palatable. But a bullet would not make sense for a bank.
Here comes the beauty of different banks with different approaches. I can live with bullet structures, with balloon structures. Balloon structures. So you have an amortization period over a couple of years, and then there is a balloon that then needs to be refinanced. I can live with that. If that balloon is in line with a normal amortization profile, in line with loan-to-value structures, then yeah, I can live with that. Coming back to your earlier question, cross-border financing, we do something in Saudi which is more sort of energy-related, utility projects. We're not yet strong on the real estate or hospitality side, but to be developed. Generally, cross-border activities among the regional banks in the other regional countries is actually not so active. Hotel projects are not that large compared to the big petchem projects or whatever in the billions of dollars of range. So one local bank or a club of a few local banks can usually finance the local hotel. So you don't see so many activities from UAE's banks to go into Qatar, Qatari banks coming here, or Oman, Bahrain, Kuwait. It's actually not so much cross-border lending activity. What we do see more, at least I can speak for ourselves, we support our clients overseas. That means we are much more active in the US, in Europe, and we're starting to become active in Asia on the hospitality side. And US and Europe, they have decades of track record there to support our clients there.
So we've got to wrap it here, unfortunately, but my observation in trying to do deals in both Saudi and in the UAE in the debt markets is very little money really flows on, except in one space, which is the bigger project financing transactions. There is a lot of mobility there, but beyond that, there's relatively limited mobility between the markets still. So, gentlemen, thank you all very much for your input. Sorry we don't have more time for more questions. And over to you, Richard.
Thanks very much indeed.